And the last 20 years, I've helped retirees navigate the most underestimated financial transition of their lives. But here's what I see over and over again. Most people think that retirement is the easy part until they realize that the rules have changed. The moment that paycheck stops, even the most confident people hesitate. This is because the rules change the moment they transition into the new phase. The strategies that got you here won't keep you here. And if you withdraw too aggressively, then there is a risk of running out. And most people only realize this until it's costing them on a monthly basis. So in this video, I'm going to tell you how to invest in this new chapter of your life step by step. Okay, so let's begin with the most common question. What exactly changes as you move into this new phase of your life? Most people walk into retirement thinking that it is the finish line, but it's not. Because the moment you stop earning and start withdrawing, you are redirected to a new start. The tools that helped you grow your wealth when you were working no longer work the same way anymore. Growth is no longer your only goal. Now it's about balance, protection, and sequence. When you're working, market dips are just noise. You could wait them out and keep contributing. But after retirement, you're not putting money in, you're just taking it out. So if the market drops and you're withdrawing at the same time, you're potentially locking in losses and shrinking your future without even realizing it. It's called sequence of return risk, and it's one of the most dangerous threats to a retiree's portfolio, and yet people don't really talk about it. Let's say that you retire with $1 million portfolio and you're pulling out $50,000 a year to live off of, and then suddenly the market drops 20%. You haven't just lost 20%, you've lost 20% plus the $50,000 that you just withdrew. The money is gone and you've got no chance to recover it. And if that happens early in your retirement years, then your portfolio's lifespan could be potentially cut almost in half, even if the market bounces back later. This is the shift that most people miss. The same investment behavior that built your wealth prior can now put it at risk. Have you thought about how your portfolio would hold up if the market were to drop immediately after you retire? Share your thoughts in the comments down below. Now, here's the biggest mistake that I see retirees make. They keep investing like they're still 45. They chase returns and stay fully exposed to the market. I've seen some retirees being invested in a all growth ETF or mutual fund and think that, well, they're diversified, so that means they're safe. But diversification is not protection, especially if everything that you own is going down at the same time. When you're retired, you can't afford to wait 5 or 10 years for a recovery. You need access to your money now, and you need your money to last. You also need it to grow in the background without exposing yourself to unnecessary risk. But most people do not adjust. They keep the same portfolio and mindset that they had while they were working, and it backfires. When the market turns, and it always does, it's not just a paper loss anymore. It's a loss that could affect how long your family can stay in their home, whether you can keep supporting your family or whether you outlive your money. The big mistake isn't your bad luck, it's your bad planning. It's thinking that retirement is a pause button instead of what it really is. You need to see it as a completely different game with different rules. If you don't follow the new rules, then you risk your freedom. Once you retire, your portfolio needs to do 3 things. First, it needs to provide a steady stream of income for you. This is because you're not retiring from work, you're retiring to a lifestyle that you have earned. Whether that means travel, time with the grandkids, or just peace of mind, you need a predictable cash flow to support it. Secondly, your portfolio needs to keep growing. You might have another 20, 30, 40 years in retirement. That's not a short-term plan. You really need to be thinking about it as an entire phase of life. If your portfolio stops growing, then inflation will quietly eat away at your future. What cost $100,000 today could easily cost $180,000 in another 20 years. Your money needs to keep pace. Finally, your portfolio needs to protect you against loss because at this stage, a loss could cost you a lot. A bad year in your 40s is just a bump in the road. A bad year when you're 67 can disrupt your entire plan. Your portfolio needs a shock absorber, something to help it sleep at night when things get noisy. These three goals often pull in opposite directions. More income means less growth. More growth means more risk. And too much protection can starve both. So how do you manage all three without sacrificing what you've worked for? That's where the real blueprint comes into place. Think of your portfolio as a house. You wouldn't live in a house that's all kitchen, all bedroom, or all garage. You'd need different rooms. And these different rooms serve different purposes in your house. Retirement investing is no different. This is where your three-bucket strategy comes into play. The first bucket is going to be your emergency fund. And this is where you're going to keep your cash. This bucket is filled with cash or ultra short-term investments that don't care what the market is doing. This bucket gives you breathing room. And if the market drops, you're not forced to sell your investments at a loss just to pay the bills. Then we have bucket number 2, and that is where your retirement paycheck lives. Think of this as the income bucket. This bucket can be filled with things like dividend-paying stocks, CDs, bond ladders, annuities, pension, anything that pays income. This is the bucket that brings in reliable cash flow with your investments. These investments are not flashy, but they are reliable and will give you steady stream of income. So just think of this as like the engine of your lifestyle. The final and third bucket is the long game. This is money that you don't need for maybe 10 plus years. Now, this bucket is going to allow you to get returns that will outpace inflation. So this bucket will support you in your later years. Think of things like stocks, REITs, other growth-oriented assets will fill this bucket. There is risk associated with these investments, but you have time on your side. When the market drops, you're not panicking because your income isn't coming from this bucket. It's coming from the first two. This blueprint doesn't just protect your money, it protects your confidence. Let me share a hypothetical story of Mark and Susan. They both followed this bucket strategy. They come to me 2 years before they're retiring. Mark had worked in tech for 35 years and Susan was a school administrator. So together they had saved about $1.4 million for their retirement. They also had a small pension and Social Security. On paper, everything looked solid, but a problem they had is that the majority of their portfolio was still in really aggressive growth stocks. They only had about 15% that was not. So 85% of that portfolio was in growth stocks. They had no income plan or withdrawal strategy. Just one big lump sum of money that looked impressive, but was dangerously exposed. I told them what I'll tell you. Retirement doesn't care how much you have saved. It cares about what you do with money that you have. So here's what we do. We restructured their portfolio. First, what we did was we filled the emergency bucket. I asked them how much they needed to have in this bucket so that they could sleep at night. And the answer for them was between 6 months and 1 year's worth of cash. So we put that cash into a high yield savings account. Now we moved on to bucket 2, which is the income bucket. Since they already have a pension and some Social Security, what I did is we looked at what that totaled up to and what the difference was. So for example, they had about $4,000 coming in between the pension and Social Security, and their monthly expenses totaled up to $6,000. So what we decided to do was to try to get a little bit more income coming in so that it would help to further cover that buffer. So then we went ahead, we created a CD ladder and a bond ladder to help generate more income. Next, we moved on to bucket 3. If you remember, that is your growth bucket. So this can have stocks in it because this is the bucket that helps you keep pace with inflation. So we did decide then to further diversify though their stock exposure because it was all basically growth and tech stocks. So we went ahead and we added in more diversification into that bucket so they didn't just have exposure to growth stocks. So fast forward to this year when we have had our turmoil in the markets, they are sitting pretty because most of their monthly income is filled by bucket 2, their Social Security, their pensions, and the income coming from the CD and the bond ladder that they have in place. Because their income was not just solely dependent on the stock market, they didn't panic and they didn't flinch. We stuck with our investment strategy because they had a plan for their money and they were able to feel secure because of that. So do you all have a plan? If not, I'm now going to break it down for you. Step 1 is to know your numbers. This is very important because most people underestimate their spending this month, or they forget to add in expenses like home maintenance or travel. This is important. Retirement is not just about survival, it's about quality of life. So don't be afraid to add up all of your numbers. The next step is to separate your money by time horizons. Do you have any short-term need for cash? That should be maybe in your emergency fund bucket or step 1. If we have needs that are further out, maybe 5 to 7 years, those can help to be covered by the income that you're generating in bucket number 2. And the money that you can afford to leave untouched for the next 7+ years, you can keep that in your growth bucket. The next step is to shift your mindset. You are no longer just an investor. You are your own pension manager. Your job is to deliver a reliable paycheck for the rest of your life. You don't have to get it perfect, but you do need to get it intentional, because hope is not a retirement plan and assumptions are expensive. But a clear, purpose-driven investment strategy is what gives you real choices. That's what lets you say yes to the life you pictured when you dreamed of retirement. This is why investing after retirement is not just about beating the market. It's about building a system that pays you back month after month, no matter what happens in the market. Because retirement isn't the end goal, it's the start of a new goal in your life. And going in without a clear plan is a mistake. You don't need to be a financial expert to ace it. You just need a strategy that will work when life doesn't go according to plan. If you don't have that yet, I can help. Tap the link below in the description to schedule your complimentary retirement strategy session. And I will guide you on how to turn what you have into a future that feels steady and secure. And if you found this video helpful, then please tune in to this next video on how to retire with a pension. Thank you. And as always, I hope you all have a lovely day.